Imagine a world where money becomes scarcer over time. Not because it's being hoarded, but because it's programmed that way. Sound intriguing? Well, that's exactly what happens with Bitcoin every few years. It's called the Bitcoin halving, and it's about to shake up the crypto world once again. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Bitcoin, the world's first and most famous cryptocurrency, has a unique feature built into its code: a hard cap of 21 million coins. Unlike traditional currencies that central banks can print at will, Bitcoin's supply is strictly limited. This scarcity is at the heart of why the Bitcoin halving matters so much to investors, miners, and the entire crypto ecosystem. Every 4 years, or more precisely, every 210,000 blocks mined, something remarkable happens. The reward that Bitcoin miners receive for validating transactions and securing the network gets cut in half. This event, known as the halving, effectively reduces the rate at which new Bitcoins enter circulation. It's like turning down the tap on a digital money fountain. The psychological and economic impact of these halvings can't be overstated. They create an artificial scarcity that often fuels investor optimism. Historically, halvings have been closely tied to bull markets in the crypto space. Why? Because when you reduce the supply of something while demand stays steady or increases, prices tend to rise. But what exactly is a Bitcoin halving? At its core, it's a pre-programmed event that occurs roughly every 4 years. It's designed to slow down Bitcoin's inflation rate gradually. When Bitcoin first launched, miners received a whopping 50 BTC for each block they successfully mined. Fast forward to today, and that reward has dropped to 6.25 BTC per block. The next halving will slash that further to just 3.125 BTC. Satoshi Nakamoto, Bitcoin's mysterious creator, embedded this halving mechanism to mimic scarce commodities like gold. The idea was to create a digital asset that becomes harder to produce over time, ensuring that Bitcoin resists the kind of hyperinflation that has plagued some traditional currencies. Looking back at previous halving cycles, we can see some fascinating patterns emerge. In 2012, the first halving saw Bitcoin's price skyrocket from about $12 to over $1,000 within a year. This proved the concept and caught the attention of early crypto enthusiasts. The 2016 halving was even more dramatic. Bitcoin's price grew from around $650 to nearly $20,000 by late 2017, sparking mainstream media coverage and introducing millions to the world of cryptocurrency. Most recently, the 2020 halving set the stage for Bitcoin's incredible run from $8,700 to its all-time high of $69,000 in 2021. However, it's crucial for investors to understand that these price surges don't happen overnight. There is typically a lag of 12 to 18 months between the halving event and the peak of the subsequent bull run. The economic theory behind halving is rooted in the concept of supply shock. When fewer new Bitcoins enter circulation, but demand remains constant or grows, basic economics suggests that the price should rise. It's similar to how gold becomes more valuable as it becomes harder to mine. This digital gold narrative has attracted investors looking for a hedge against inflation, especially in times of economic uncertainty. The regular halvings reinforce this idea, creating a predictable scarcity that many find appealing. Okay. But halvings don't just affect investors. They have a massive impact on Bitcoin miners. When rewards are cut in half, many miners, especially those with high energy costs, face a serious profitability challenge. It's a classic case of survival of the fittest, where only the most efficient operations with access to cheap electricity can thrive post-halving. The shakeout isn't necessarily bad for the network, though. Okay. Over time, difficulty adjustments help balance mining incentives, ensuring the security and functionality of the Bitcoin blockchain remains intact. In recent years, we've seen a significant shift in the types of players involved in the Bitcoin market. While earlier cycles were largely driven by retail investors, today we're seeing major institutions like BlackRock, Fidelity, and various ETF providers bringing massive amounts of capital to the table. This institutional involvement could potentially amplify the effects of future halvings. With larger investment volumes and longer-term capital commitments, these big players view the halving as a signal of Bitcoin's controlled monetary policy, reinforcing its role as a serious asset class. However, it's important to address some risks and misconceptions about halvings. First and foremost, prices don't surge overnight just because a halving occurs. The lagging effect we mentioned earlier often confuses new investors who expect immediate results. There's also the theory that halvings are priced in, meaning that the market anticipates the event and some of the price increase happens before the actual halving. This can lead to disappointment for those expecting a sudden post-halving boom. And let's not forget, Bitcoin remains a highly speculative asset, even around halvings. Investors should be prepared for sharp corrections and extreme volatility. So what can we expect from the next halving? Predictions vary widely. Some bullish analysts suggest Bitcoin could break $100,000 within 12 to 18 months after the event. More cautious voices argue that returns may diminish with each cycle as the Bitcoin market matures. It's crucial to remember that external factors like interest rates, global regulations, and adoption rates will heavily influence outcomes. The halving alone doesn't dictate price movements. For investors looking to navigate these choppy waters, several strategies can help. Dollar cost averaging DCA, spreading out purchases over time, can help reduce risk from Bitcoin's notorious volatility. Long-term holding, or HODLing as it's known in crypto circles, has historically yielded stronger returns than short-term trading. Diversification is also key. While Bitcoin may be the star of the crypto show, balancing your portfolio with other assets or even select altcoins can help manage risk. As we wrap up, remember that the Bitcoin halving is more than just a technical event. It's a catalyst that shapes market psychology and influences both retail and institutional behavior. Understanding its history and applying disciplined investment strategies is far more valuable than chasing hype or trying to time the market perfectly. We'd love to hear your thoughts on the upcoming halving. What are your predictions? How are you preparing your investment strategy? Share your ideas in the comments below. Hit that subscribe button and join our growing community of savvy crypto investors. Remember, in the world of Bitcoin, knowledge truly is power and potentially profit. Till next time, stay curious and invest wisely.